Hi, everybody. My name is Brian Ullman. I'm a certified financial planner and financial advisor here at Ford Financial Group. Today, we are going to be talking about the basics of investing. And this is part of our monthly webinar series that we put together. And in this particular instance, this is one of what's going to be a few basics kinds of webinars. In the past, we've had webinars covering things like Social Security collection strategies or Social Security benefit collection strategies. Our webinar in March is going to be with a physician talking about COVID vaccines and the impact on coronavirus that the vaccines are having. And so this is one of many webinars, but this is also part of a subset of those webinars that are on the basics that are kind of designed to help understand the most fundamental aspects of financial issues. Today, we're talking about the basics of investing. The next one of our basics webinars, which will be a few months from now, will be on the basics of budgeting, which is an important kind of aspect. It's hard to invest money if you haven't budgeted some savings in there. And so that's a little bit of a kind of an explanation on our webinars and how we're doing them and where this particular basics of investing webinar fits in with the rest of the webinars that we do, and then specifically on this basics series that we have as well. We've had some technical issues with signups for this webinar, and so there won't be any, I won't be fielding any questions to this for this webinar. We're also recording it, and so if you did have some sign up issues, hopefully you will be able to see the recording of this and have your questions answered. I will say right off the bat, and I'll say this again as we continue on this presentation, that if you have questions about anything that you're seeing today, you can either email your advisor here at Ford Financial Group if you have one already. If you're watching this and you don't have an advisor here at Ford Financial Group, you can email us at info@fordfg.com. That's our kind of general inbox. And it can be your questions can be forwarded to an advisor who can help you answer those questions and kind of get you squared away on the basics of investing and how investing might be able to work for you. So with that in mind, I'm going to go ahead and share my screen here. So you should be able to see here the basics of investing. And again, I'll just start by thanking you for watching this presentation, whether you're attending in person or if you're watching the video recording of this. My name again is Brian Ullman. I'm a certified financial planner. I'm a financial advisor and one of the managing partners here at Ford Financial Group. And today's topic is the basics of investing. I think many people find it a bit challenging to get interested and engaged with investing and the planning and kind of the strategizing that comes with it. And that's understandable. There's a lot to learn. There's a lot to know and a lot to understand. It's not like we teach this skill set in high school or college for anybody. If you don't have experience with investing, the chances are that you consider yourself to be in one of the following categories. Either you want to figure it out yourself, or you might be in the middle category here. You just need a little bit of guidance and you'll be okay. Or if I would describe this as this last category, the please, can someone just take care of this for me, is the kind of strategy I like to use with my mechanic, right? I think a good financial advisor is like having a good mechanic, which is to say, be straight with me, fix what needs to be fixed. I'll pay you a fair price for that. And then when I go pick up my car, you don't really need to pop the hood and tell me every little thing that you did. And so I would say that's probably where we fall into with this latter category here. Just take care of it for me. And it's important to recognize that over time, the way that you approach investing can change. And no matter where you are, I think a financial advisor or our office, Ford Financial Group, can help you out if you think you need some help with it. And we can talk about that a little bit later. But today's presentation is intended to give you some of the basic investing concepts that you need to know, along with some common best practices. I find that if investors know a little bit about their investments, it helps ease concerns and give them a little bit of understanding, so it's easier to work with a financial advisor so you can work to try and optimize things. I think that the confidence and sense of empowerment that comes with having a formal investment strategies for your financial goals can be incredibly powerful. It helps when we reach points like we did almost exactly a year ago when the market's cratering because last year, because of COVID concerns. You have the confidence to know that you're not just haphazardly doing things, you have a plan in place and you can kind of weather the ups and downs that inevitably come through investing in markets. Before we get started with the basics, let's look at something that's growing in popularity with the investing world. And I think it's a great place to start and kind of get the investment juices flowing. And more investors are seeking out investments in mutual funds or exchange traded funds that match up with their personal causes or values. This can be a really good way of connecting with your investment strategy in your portfolio and give you a little bit more ownership instead of owning kind of the vague, kind of nebulous XYZ mutual fund or XYZ ETF. Some of these are called socially responsible investing strategies, or there are other similar names to that, but you can have an investing strategy that focuses on climate action here, or defense and cybersecurity. That's another. Cybersecurity is becoming a popular investing theme. Emerging consumers, so gaining exposure to emerging economies or emerging. We in our portfolios have emerging markets as part of our investment strategy because there are certain corners of the world that have more room to grow than others. And so that's another way of investing. Gender diversity is another important part of the socially responsible kinds of portfolios that we have for some. Other examples are biomedicine and other kind of health-related technologies. Global investing, or even focusing on robotics and artificial intelligence. If you are a kind of a techie kind of person, the focus could be on that as well. So, with that in mind and having the idea that it's not just some sort of, you don't need to only have some broad portfolio. You want to be diverse, of course, but you can also have a kind of a portfolio that's made up of the things that interest you and you think are good investments for the long run. Let's take a look at the first important question that you need to ask yourself before really digging into investing, and that is, are you ready to invest? Investing can seem like an intimidating process, but the sooner you start, the easier it's going to be to build a nest egg for your future. In fact, I was talking earlier today with a client of ours who is 20 years old, and she's begun investing, and in fact, she's going to continue by adding in her tax refund that she's going to be getting this year. And she has 40 or 50 more years to go. So starting early is always an important idea here. And since investing always includes some risk, it's important to have a solid financial foundation before you begin. And what we have up here are some key things to make sure you've covered before you really begin to invest, to make sure that you're ready. And the first is having a steady income, right? If you can't meet your monthly bills, you can't peel some off to go put it somewhere else. So having an income that meets your needs is the first a critical component here. So borrowing money to invest is not a good idea, of course. If you have money left over at the end of the month of meeting your financial obligations, that's where you can look, provided you have a good emergency savings set up. That's where you're looking to use that money to then invest, right? And so it's about having an income and then budgeting that income. And also then once you've budgeted that income and you have some to invest, that you've considered the effect of upcoming personal changes, like you might be saving for a house, or you might be wanting to pay off your car. You might have kids that need to have their college savings. There are other things that can come into play. And then, as I mentioned earlier, of course, you have an emergency savings account. Because investing is for the long term. And so even if you're investing in a way where you can tap into that money to help pay for expenses, the longer you leave your investments alone, the better off you're going to be. And so having that nest egg or emergency fund of 3 to 6 months allows you the freedom to take the investment part of your savings and invest it for the long term and let it go. There's an old saying, it's time in the market, not timing the market. And so the more that you can leave your investments alone, the better off it's going to be. So let's go on to the next slide here. Being ready to invest also is ready to make a commitment to increase your knowledge by looking at financial news and staying abreast of what's going on. The Wall Street Journal is a way that lots of people have done that for a very long time, whether it's the app or wallstreetjournal.com. It's an investment-specific kind of publication. Others are Bloomberg would be another one. Financial media like Fox Business or CNBC is another way that people get their news. And then we also have at Ford Financial Group, we have a blog that we post almost daily to, in addition to our podcast and in addition to our monthly and quarterly newsletters, that can help keep you up to speed on what's going on with markets and answer some of those questions. So if you like today, for example, interest rates have been going up, so the market is kind of struggling to digest that news today, and you can kind of see that that's going on. Knowledge is power, and I think having a good understanding of what's going on with markets, or at least a cursory understanding of what's going on with markets, can help you become a patient investor. And I think that's what we're looking for here. We also partner with LPL at our office, and they offer a weekly insights report and some other research information there. So lots of places for you to get your financial information so you can kind of understand and have a comfort level with what's going on with markets. So let's help jumpstart some of your investing knowledge. And there are some major investing benchmarks really that you might be sort of familiar with, but I think you should probably know more about. One is the Dow. The Dow is the Dow Jones Industrial Average. It's the oldest and best known of the American stock market indexes. There's more than one, but the Dow is probably the best known. The stocks in the Dow are actually selected by the editors of the Wall Street Journal, which is something that's not often known by people. And the Wall Street Journal that's the editors are who's selecting who's in the Dow, and the companies are represented that are represented in the index are actually pretty diverse and represent all sorts of major business sectors. And I think you'd actually recognize most, if not all, the names that are represented in the Dow. It includes Johnson & Johnson, Coca-Cola, McDonald's. And really the criteria to get in on the Dow index is that the companies are leaders in their industry and are very large. These are kind of the blue chip names that you think about. It takes a significant change in a company for it to be removed from the index. And as a result, the Dow Jones Industrial Average is considered an important and consistent benchmark in evaluating how the stock market in general is doing. And I'm sure you see this when you're watching the nightly news, where they're reporting that the Dow is up or down so much, and it is kind of considered this barometer of how the broader stock market is doing, even though it's only 30 blue chip stocks. It is a reliable indicator here. Now, perhaps a less familiar but also important marketplace is known as the NASDAQ exchange. You may have heard the NASDAQ before. It actually stands for National Association of Securities Dealers Automated Quotations System. It's probably the only time you're ever going to hear this, and you certainly don't need to remember it. Oftentimes, everybody just refers to it by the phonetic pronunciation, which is the NASDAQ. In the last quarter century, the NASDAQ really has emerged as one of the largest and most popular stock exchanges, and really was the first exchange to offer online trading, which is now pretty well done across the board. The kinds of stocks that are traded on the NASDAQ tend to be tech companies. So you're looking at names like Apple and Facebook, Microsoft, Google. Yet the companies on the NASDAQ don't have to be as huge as those names that I just mentioned, like Apple and Facebook. Smaller companies like Angie's List, which is a website that does peer-to-peer reviews of home contractors, or 1-800-Flowers is another one. Those are all listed on the NASDAQ exchange as well. And so while the NASDAQ generally tends to include many tech companies, it also has some banking companies, airlines like Spirit Airlines, and even a few non-tech businesses like Starbucks or the shoe company Steve Madden. And then, as you might expect, bigger tech names like Amazon are also traded on the NASDAQ. So now that we've covered some ways to set yourself up to kind of for investing success, whether it's saving or kind of becoming familiar with the indices, let's look at what we like to call the 4 steps to becoming an investor. And so as we go to step 1, the first step is to learn which investments are appropriate for your financial goals, whether you're saving for retirement, whether you're buying a new home, funding a college education, you have other financial goals beside that. We want to take a quick look at the key types of investments that are available to help you meet those financial goals. And the first one here is a stock. If you ask somebody, do you know what stock is? A lot of people will say yes. And then you say, okay, well, explain it to me. And then it's more difficult to explain. So let's go through the fundamentals here just for a moment. A stock is also known as shares or equity in a company. And it's a type of security that signifies a proportionate ownership in the issuing corporation. A lot of jargon there. It means you are a part owner, even if it's just a sliver of a company whose stock you bought. And it entitles the stockholder or the shareholder to a proportion of that company's assets or earnings. So you are an owner of whether it's a mom and pop place down the street, if you own shares of that, or if you have Starbucks, like we mentioned earlier. Stocks are bought and sold predominantly on stock exchanges and are the foundation of nearly every single investment portfolio. And when I say they're bought and sold on stock exchanges, it's things like the NASDAQ, right? Now, stocks and stock mutual funds, which is often how people invest in stocks, have a high return potential, but the potential risk is also there as well. So for the average investor that are considering kind of a long-term investment goal, like a 401k or an IRA, where you have much more time on your side and you can afford to be a little bit more aggressive, that's where we tend to see a higher allocation to stocks in a portfolio and therefore more risk. And so while stocks may not make more sense for a short-term investment goal where you have safety and stability as more of a priority, stocks or stock mutual funds or stock exchange traded funds can make more sense for a longer-term strategy. The other kind of investment that we think of, and you often hear referred to as, oh, I invest in stocks and bonds, right? Bonds are a different kind of investment. They're used by companies or municipalities or states or even sovereign governments like the US government to finance projects and operations. And so owners of bonds are debt holders or creditors of the issuer. Think about a bond as an IOU, right? It's a loan that's being issued by a company or municipality, a state, the government, and you are the loan holder or the debt holder of that IOU. And so we can kind of get into the nitty gritty here just briefly. Bond details can include the end date when the principal of the loan is due, right? There's a term on the loan. And that's when that term is up, that amount is to be paid to the bond owner. And usually the bond then also includes terms like interest payments that are made by the borrower or the issuer to the bond holder. And historically, bonds or bond mutual funds are known for their potential to generate consistent, moderate returns, which work a little bit better in a medium-term investment goal, like a college fund, for example, where you can take on some risk, but you don't want to take on a lot of risks. And really, if you think about it in terms of as you get closer to retirement, like within 10 years of retirement, bonds or bond mutual funds can also become a bigger and bigger part of your retirement account or your retirement portfolio if you're looking to be less heavy on stocks, but you still want a little bit of growth potential in there. I'll take this opportunity, though, to say your age alone doesn't dictate how much you should have in stocks or should have in bonds. I mentioned earlier that it's for someone like a college fund. If you think about it, like a 16-year-old is pretty close to heading off to college at 18. And so they need to make sure that they are more conservatively invested because they need that money pretty soon within the next couple of years to do things like pay for tuition or pay for books. And so if you're just looking at someone's age, you'd say, well, they're 16 years old, they should be aggressively invested, but that's not actually the answer here. They're close to needing the money. And so likewise, you may have an investor who's well into their 70s, but maybe doesn't need the money. And they might be a little bit more aggressively invested because they don't have any plans on taking that money and using it to supplement their Social Security income or their pension. So keep that in mind when we're talking about the ratio of stocks to bonds and how that should be calibrated in one's portfolio. There's also like cash equivalents that could be in a portfolio. So something like a money market fund. They're known money market funds or the equivalent kind of cash equivalents have consistent but much lower returns, although with lower risk, which might make more sense for a really short-term investing goal like saving for a down payment on a house. And then as you get closer to retirement, like within 5 to 10 years, cash equivalents could become part of your bigger kind of overall portfolio strategy if you're starting to look to minimize risk a little bit. But like with the others, higher risk reward can result in higher reward, but lower risk, lower reward, particularly in the kind of low interest rate environment that we're in right now as we're recording this late February 2021. And so here's some perspective on the major asset classes and how they've performed over the long term, right? History reminds us that the greater the risk, the greater reward, as I mentioned. And so these are historical returns of these key asset classes from 1926 to 2018. So this doesn't include these last couple of years. 2019 and 2020 were actually very, very good. And so these numbers have probably actually gone up from here, but you can see smaller stocks are a little bit higher risk and over the long term, a higher reward. Large stocks, still riskier, higher reward. Whereas you get down into treasury bills and they're only slightly beating inflation over the last almost 100 years now. And so your real return on the treasury bills is pretty small because you have to figure that inflation is eating away a little bit of that purchasing power. The basics where we start with investing is that you want to get a return that's at least keeping up with inflation, so you're maintaining your purchasing power going forward. And once you kind of have figured that part out, then you might be able to invest, depending on your time frame, a little bit more aggressively. So those are kind of the first steps on becoming an investor. The second step to becoming an investor is embracing diversification. And this really is one of the most fundamental aspects of investing, is putting your money into a number of different types of investment options that include different types of asset classes and different kind of risk classifications, really. I think generally speaking, if your dollars are invested in materially different kinds of investments and market conditions cause one of your investments to not do well, all of your money won't be affected as negatively. And there's no better way, I think, to illustrate this than to look into the story of the Lifesavers candy. So here's the story of Lifesavers. Clarence Crane invented Lifesavers in 1912. He manufactured only one flavor of Lifesavers, which is the peppermint. In 1913, Crane was approached by Edward J. Noble, and Noble suggested that offering different flavors of Lifesavers would attract more customers. Crane wasn't interested in the concept, but he agreed to sell the Lifesavers business to Noble for $2,900. Now, in his lifetime, Noble then went on to develop a billion-dollar business manufacturing different flavored Lifesavers. And I can't imagine a pack of Lifesavers not having different flavors of candy in it, actually. But by diversifying his product, he appealed to more people and protected his business from the risk of one flavor losing its popularity. So like the Lifesavers, diversification can help with your investments too. You want to spread out your risk among different asset classes so that you can protect from big dips in one particular corner of the market. I think probably a more direct example would be the tech bubble that came and went in the early 2000s. If you had all of your eggs in one basket, you were really feeling the brunt of that. Whereas if you were diversified, you were able to spread that risk out a little bit. So with diversification in mind, let's move on to step 3 to becoming an investor. And it's a little bit of an economics 101 lesson. And it's really important to understand how the economy can affect your portfolio because the state of the economy, which is how a country can use resources and money to produce goods and services, really affects stock market activity. Whether the economy is growing, shrinking, standing still, it all influences stock performance. And so to understand the impact of the economy on your portfolio, I think we need to take a look at how a few different economic factors can affect stock prices here. So we have two kinds of markets, if you will. There is a bull market where investor confidence is really high, stock prices are on the rise, and most stock holdings are increasing with value. And then on the flip side, you have a bear market where investors are nervous, stock prices are decreasing, and stocks might actually be undervalued versus where they ought to be. And this can really be an opportunity. The bear market can be an opportunity to buy a stake in good companies at a discount to the stock prices if that's appropriate for your situation. Now, I will say, I'm going to take this opportunity to say, even in a bear market, there may be opportunity there, but we don't want to try and time markets, right? Trying to market time is a foolish endeavor that generally doesn't work for anyone, no matter how good you are, even Warren Buffett. And it's really time in the market, not timing the market. And so bear markets can present opportunity, but you don't want to try and do the whole sell high, buy low stuff over your lifetime, because chances are you're just going to shoot yourself in the foot. Now, keeping on this kind of economic theme here, when there's inflation, prices are rising and purchasing power is falling. So I think we all have an understanding of inflation, like a dollar doesn't buy what it used to. But when inflation spikes too high, people can't afford to buy as much as they could, and therefore corporations start to lose sales, causing their stock prices to drop. And that can create a drop in investment values, really. Now, when there's low inflation, like what we've had in the last 10 years or so, that can actually indicate a healthy economy, which can actually be good for the stock market and stock prices, which is almost precisely what we've seen over the last year. And so as we've seen some turbulence with markets here, a lot of it's related to some concerns about inflation moving higher. Now, we're going from inflation being essentially non-existent to moving back into existence. And so I wouldn't get too worked up about what the market's been doing here lately. But it's more movement on the concern that high inflation could be in store down the road. So that's some kind of current events for you here as we're looking at the basics of investing. The other thing to understand here is interest rates also, because the interest rates include credit card interest rates, mortgage rates, car loan rates, and even the savings rates that you receive on a savings account at the bank, which right now are absurdly low, maybe even at an insulting level. Now, when interest rates increase, stock prices tend to decrease. And when interest rates drop, stock prices usually rise. And so in 2019, actually, the Federal Reserve, which is also known as the Fed, which is the government entity that's responsible for implementing interest rate strategies to help support the economy, the Fed decreased interest rates on 3 separate occasions. That's actually one of the things that helped push markets higher in 2019. And they were doing this in an attempt to help offset a potential recession and avoid an economic downturn. Now, there's an inverse relationship with the Fed, there's an inverse relationship with the rate setting by the Fed and with stock prices. So when rates are going up, generally stock prices are going down. When rates are going down, generally stock prices are going up. And so that's why we have a bit of an obsession among investors about what the Federal Reserve is doing with interest rates, and where folks are speculating that the Fed will go with interest rates. It's because of this correlation with stock prices. Now, step 4 is seeking professional help if you think that you need it. And even though this presentation is designed to give you some basics to get started with investing, it's important to recognize that sometimes you can't always do it all yourself. And so you need to seek professional help when you think it's prudent. It's important enough for our 4th step to be to look for professional help as you become a real investor here. I know Ford Financial Group here and other professional, like certified financial planners, can help give you guidance to help figure out what your financial goals are, and then how through investing in your investment strategy you can work to achieve those. And there's a few ways a professional can help. And I draw this analogy to a mechanic. You know, you can do some things on your car. You can maybe change the windshield wipers, and that's easy enough. But when it gets down to actually doing more meaningful things to your car, chances are you go to a professional to get it done. And I would say it's kind of akin to this. And so here, the advisors at Ford Financial Group can help you figure out kind of how different portfolios can be balanced out to work to help you achieve your financial goals. I think part of that is helping you and working with you to determine an appropriate risk strategy or your risk tolerance, because really what you're trying to do is figure out how much you can risk. And that's based on your personality traits, your time frame, but the kind of risk that you want to take on to then achieve the kinds of returns that you need to achieve kind of in the long run. And so I think the other important part is that the advisors here can also help you track your progress. Because if you're kind of a normal person doing the DIY 401k, chances are you toss some money into a fund and you kind of don't understand it and you don't look at it for a long time. And if you're investing in the long run, you probably want to be able to keep track of your progress and make those rebalancing adjustments as things change, right? As interest rates go up or go down or markets move or things fall in and out of favor, you want to be able to make some of those adjustments. One of the things that we can help you figure out, as we were talking about risk tolerance, is trying to figure out what kind of investor you are and what kind of tolerance for investment risk that you have. And so if you're watching this and you're interested in kind of filling out this quiz that we have, email us at info@fordfg.com. And we can we'll shoot you the quiz. You can fill it out. You can send it back to us. And then we can give you a call and kind of help you line up the results from this quiz with what kind of portfolio and asset allocation might work best for your kind of investing risk. And so I think it's an interesting exercise to do where you're not going through and saying, what kind of returns do you want? We're taking a look first and saying, what kind of risk can you bear? And then from there, figure out what kind of portfolio construction would work best for you and the type of investor that you are. So again, email us at info@fordfg.com and ask for the risk tolerance quiz. And we will go ahead and send one to you. And then we can also follow up and set up a time to help figure out where you land on the spectrum of investing risk and figure out your asset allocation there. And when I say spectrum of investing risk, if you're a client already, and you've probably heard me talk about this, it's easy to look at things in a mix of stocks and bonds and kind of chart it on a spectrum where one might be really conservative and a 5 might be really aggressive. And you can see here, a conservative mix might be something that has lots more bonds. So maybe upwards of 80% bonds. Whereas something more middle of the road might be somewhere around a 50 or 60% stock allocation. And then something more aggressive could be all stocks or stocks with maybe some aggressive kinds of bonds. And so that's based on your investment risk tolerance. This is the kind of investment mix that we can help figure out with you and choose not just the mix of stocks and bonds, but what kinds of stocks and what kinds of bonds you might keep in that portfolio. And so that's where a professional can come in, where you're not just flinging money at a mutual fund and hoping for the best, but actually developing an investment strategy based on your tolerance for risk and for your kind of time frame to figure out what could best work for you here. And so that's where working with a professional can really come into play here. And I think that's where we can probably help get you started as you're beginning as an investor, as you get a little bit of understanding and knowledge. And then as you move on, kind of start saving and then working with a financial advisor to figure out what your investment mix ought to be. And so I'll wrap up with this last slide here. These are some required disclosures that we are required to give you. This is for educational purposes. It is not investment advice specific to you, of course. And I will just summarize with, we can't predict the future, as you probably well know. And then finally, here's our contact information. Again, my name is Brian Ullman. I'm a certified financial planner here at Ford Financial Group, and I'm available to help you here. Or if you have other questions and you're already working with an advisor, I'd encourage you to reach out to one of the advisors at our office for help. Or if generally you're looking for help from our firm and you're not already working with one of the advisors, info@FordFG is where you can email us for that risk profile questionnaire or to talk with an advisor specifically. So I hope you found this helpful, and I look forward to seeing you again in March, about a month from now, where we will go over and work with actually a physician specifically talking about COVID and the vaccine's effects on our economy. So thanks for watching. I look forward to talking to you in the next one.